Morning, folks. Ever since we did the episode on Bill Ackman, Carl Icahn, and their feud over Ackman's short position on Herbalife, I really wanted to dig into short selling to find out how it started. But more than that, I wanted to find other great stories of short selling. Now, look, anybody who's interested in business stories, you'll know about the GameStop short selling saga from a few years ago. And that's one I'll definitely cover in a full episode. And we also, as I mentioned, have an hour-long episode on the Bill Ackman, Carl Icahn Herbalife short. That's in our back catalogue. It's free for everyone. It's a great episode. But in this episode, I'm going to look at a few different stories. We're going to look at the Piggly Wiggly short sell from 1923. We're going to look at Jesse Livermore, the guy who made over 1 billion from short selling in the 1929 crash, and considered by many to be the best trader ever. I'm going to look at Jim Chanos, the guy who successfully shorted Enron. There's the story about how Porsche, the car company, they actually outsmarted short sellers with a fantastic short squeeze. It's a brilliant story. And finally, we'll look at the Hindenburg Group and their Adani short. They're brilliant stories, so enjoy. Before we dig into it though, a quick reminder. While these shorter weekly episodes, released every Wednesday, are free for everyone, for just $1.99 a month, you get access to our co-hosted hour-long episodes released on the first of every month, where Keith and I do an even deeper dive into an incredible business story. Some of these hour-long episodes are still free in our back catalogue, so you can get a taste of what to expect. As well as getting access to these monthly, co-hosted, hour-long plus episodes, behind the paywall right now is a fantastic 3-part series on Disney. And over the coming months, we'll be adding more bonus content for subscribers regularly. Also, subscribers will get access to these weekly episodes ad-free, so you won't have to listen to me talk about our subscriber program in each of these weekly episodes. So it's great value for just $1.99 a month. You can subscribe via Apple subscriptions, Spotify subscriptions, or on Patreon using the link below, or go to patreon.com/great business stories. So the story of short selling. Let's have a look at the history and what short selling is about as well. In basic terms, short selling involves borrowing a security or shares whose price you think is going to fall and then selling it on the open market. You then buy back the same stock later, hopefully for a lower price than you initially sold it for. You then return the borrowed stock to whomever you bought it from, and you pocket the difference. So that's it. It's pretty simple, really. But the big risk with short selling is that if the price of the stock goes up, the short seller is on the hook and will be forced to buy back the shares, and as a result they incur a massive loss, and of course the shares could go up and up and up. Now, short selling has always had a bit of a PR problem because at its core really it's a bet against a company. It's a way to profit when stock price falls, and to many people that feels wrong. It's seen as profiting off someone else's misfortune, and in a way that's true. When a company's stock tanks, real people get hurt. Employees, suppliers, local governments, pension funds, yes, big investors, big hedge funds, but crucially also small investors. So short sellers get labelled as vultures, like they're circling over struggling companies, waiting for their moment to strike. And the criticism doesn't stop there, because short selling is often accused of causing wild price swings, fueling market volatility. When stock starts dropping, short sellers of course pile on, pushing the prices down even further and sometimes triggering panic selling. And as a result, short sellers have been blamed from everything from market downturns to full-blown crashes. But if you actually look at the history of financial crashes, short selling has never really been the cause. It's just an easy scapegoat. When things go south, it's much easier for governments and for companies to point the finger at short sellers rather than to admit their own mistakes or to acknowledge deeper systemic issues. And this was true, I remember, in the 2008 financial crisis. I remember in Ireland, our biggest bank at the time, or the poster boy bank at the time, was Anglo-Irish. And when the financial crash happened and all their money was tied up in property deals that they'd done, they were in deep, deep trouble. But both they and the government turned around and said, oh, at the start anyway, they said, oh, it's all the short sellers. We're in perfectly good health. It's the short sellers that are bringing our stock price down, which of course was total BS. Because the reality is, love them or hate them, short sellers do serve a purpose. Markets need optimists, but they also need pessimists. They need buyers and sellers in order to function properly. And as we shall see, short sellers expose frauds. They uncover overvaluation. And they do keep the market efficient. In other words, they're a necessary evil, I suppose, though evil I don't think is the right word. So let's have a look at the history. And it dates back a long time. It started in the early 1600s, and the first known short sale was carried out in 1609 by Isaac Lemaire. He was a former director of the Dutch East India Company, which was called the VOC. And after he was expelled from the company over embezzlement accusations, Lemaire formed this secret group that began to bet against VOC stock. And he and his syndicate used tactics now known as naked short selling. This is selling shares that they didn't actually own in the hopes of buying them back at a lower price. How this is legal, and it was legal up until recently in lots of countries, is amazing, because naked short selling bypasses a key step in traditional short selling, i.e. borrowing shares before selling them. Naked short selling involves selling stock without securing the stock or the shares first. It's like selling a car you don't own and hoping you can find one to deliver later. And it essentially floods the market with phantom shares. And this, of course, can distort prices and undermine confidence, especially in less liquid markets. Now, it is largely banned in the US and the EU, especially after the 2008 financial crisis. But due to loopholes and quirks in electronic trading systems, naked short selling hasn't disappeared entirely, which I find incredible. Now, Lemaire's plan wasn't just financial, though. It was also very strategic, because his group started spreading rumours of VOC shipwrecks and losses at sea. And of course, this helped drive the stock price down. The VOC accused him of harming investors, particularly widows and orphans who were dependent on dividends from the VOC. But Lemaire saw himself as also exposing poor leadership. He saw himself as kind of an early shareholder activist. Now, the Dutch government weren't going to stand for it. The VOC at that time were the largest company in the world, and they responded, the Dutch government, with the world's first stock market regulation, banning naked short selling altogether. Now, that spelled disaster for Lemaire's syndicate. VOC stock were bounded. Lemaire's group was forced to cover their short positions at higher prices, and most of them went bankrupt. Indeed, Lemaire himself lost 70% of his fortune. Now we're going to jump 300 years to 1923 to the Piggly Wiggly short squeeze. I love this name. So, what is this? So, Clarence Saunders was this innovative American grocer, and he really revolutionised the retail industry by founding this grocer called Piggly Wiggly in 1916. It was the first self-service grocery store. And by 1922, Piggly Wiggly had over 1,200 stores across the US. However, that same year, some franchisees in New York, they were encountering financial difficulties, and this led speculators on Wall Street to believe that maybe the company's stock was overvalued. And so, these speculators began short-selling Piggly Wiggly shares. That name just gets me. Betting that the stock price would decline. Now, in response, Saunders attempted to execute a corner in the market. So what he did was he borrowed $10 million, aggressively started purchasing Piggly Wiggly stock to drive up its price, and in so doing, forced the short sellers to cover their positions at higher costs. And by March 1923, he claimed to control 198,000 of the outstanding 200,000 shares, and this caused the stock price of Piggly Wiggly to boom from $39 to $124. However, the New York Stock Exchange, they intervened. They suspended trading of all Piggly Wiggly stock, and in doing so, they extended the delivery deadline for short sellers. And of course, this totally undermined Saunders' strategy. These measures then led to a decline in the stock's value, and they left Saunders unable to meet his financial obligations. As a result of all this, he had to resign as president of Piggly Wiggly. He was declared bankrupt. He had to relinquish all his assets, including his Memphis mansion, known, of course, as the Pink Palace. Great story, and one that I think I'm going to do a full episode on, either myself or Keith, or I'll do one of the shorter episodes, but I want to find out more about that. Next, we come on a few more years to Jesse Livermore. This guy is interesting. I mean, I'm talking about doing an episode on Piggly Wiggly. I am definitely doing an episode on Jesse Livermore. So he was a self-taught trading prodigy, and he rose from being just a $5 a week board boy. A board boy was somebody who copied the share prices onto a blackboard from the ticker tape recordings from the stock exchange, and he became one of history's most influential speculators. He was known as the Great Bear of Wall Street, and he really did revolutionize technical analysis and trend following strategies, because rather than relying on traditional analysis back then, he focused on price patterns, volume shifts, and what he called pivotal points. These were key moments in a stock's price movement that signaled maybe a potential shift in trend. And he was meticulous in tracking market trends, and he famously stated, "Prices move in trends. The trick is to identify them early." But beyond the technical prowess, Livermore also understood the psychological demands of trading. His journal showed that he engaged in rigorous self-examination, and he warned traders, and this is very prescient. He said, "The human side is the greatest enemy of the average speculator," and that is so true. Now, during the panic of 1907, he shorted overvalued stocks. He made $1 million in a single day. But his biggest success came during the 1929 crash, because he anticipated the bubble and he built stealth short positions. And over the course of the crash, he amassed a fortune of 100 million, which is worth about 1.5 billion in today. Now, this cemented his reputation, but of course it also made him a target. There was public outrage that he was profiting out of this crash, and he got death threats. He had to hire bodyguards, and despite his obvious trading genius, Livermore's fortunes, they were very, very volatile. Over leverage led to many cycles of bankruptcy, and his personal life was, I suppose, tumultuous is what you'd say. In 1935, for example, his wife Dorothy shot their son dead in a drunken fight, and it was one of the biggest scandals of the era. And by 1940, Livermore was bankrupt again, and he died by suicide later that year. Now, in the aftermath of the crash, short sellers like Livermore became, obviously, the scapegoats. We mentioned this earlier. President Herbert Hoover called them a national discredit. Congressional hearings, they accused the short sellers of orchestrating the crash. But, as we shall see, analysis that was done later, it debunked these claims, because the analysis showed that short interest before the crash made up just 0.15% of all shares on the New York Stock Exchange. So nowhere near enough to have caused the market collapse. But this tag, this legacy, it shaped financial policies for decades to come. Short selling became viewed as this destabilizing force, and it still is viewed in that way. So the next story we're going to talk about This starts in 2000 when Jim Chanos of Kinnicus Associates uncovered one of the biggest corporate frauds in history. His short-selling thesis on Enron, which collapsed in 2001, erasing $74 billion in market value, it exposed massive flaws in Wall Street's due diligence, and it was based on this deep dive into the company that revealed really glaring red flags to him. One of the red flags that Chanos identified was Enron using this thing called gain on sale accounting. And this is where they recognize future hypothetical profits up front, a tactic that Chanos rightly described as creating earnings out of thin air, because it involved booking the projected future profits of long-term contracts as immediate earnings. And this, of course, allowed the company to inflate its current revenue and appear more profitable than it actually was. To put it in simple terms, say if I did a contract with you, say with your company, for the next 10 years, I'm going to look after the advertising for your company, and I'm going to project over the next 10 years, we're going to make 3 billion. Okay, now that's all projections, that's all pie in the sky. It might be based on some sort of fact, but until the actual earnings are made, it is pie in the sky. But what Enron did was they just then booked that 3 billion as earnings, as if it was real. It was crazy. Another thing they did was that Enron's 2010K filings referenced off-balance sheet entities. These were later revealed as the famous Raptors and LJM partnerships, and these were used to hide debt and inflate profits. Chanos also noticed that executives, including CEO Jeff Skilling, he sold massive amounts of stock, while high-level departures also raised suspicions about instability within the company. Now, there is a fantastic book on this, and we will do an episode on Enron at some stage, but I think most people know the Enron story. But if you don't, I really recommend you get the book, The Smartest Guys in the Room, by Bethany McLean and Peter Rifkin, I think it is. Fantastic book. One of my favourite books of all time. But anyway, based on his research, Chanos began shorting Enron stock in November 2000 at around $60 per share. Slowly but surely, his analysis, it started to gain traction in early 2001. And media coverage kind of forced analysts to re-examine Enron's finances and how it was accounting for all these profits. And by late 2001, the stock had collapsed to pennies, netting Kinnicus Associates an estimated $500 million in profits. And Chanos' approach, this way of blending forensic accounting with behavioural analysis, it became a model for identifying corporate frauds. It laid the foundation as well for uncovering later financial scandals, including Wirecard and Valiant. And so it really does demonstrate this vital role that independent short sellers play in exposing these kind of financial shenanigans that we saw in Enron. Now, the dot-com bubble, that presented a unique challenge for short sellers, and I really feel sorry for the short sellers who got caught up in this, because betting against startups like Pets.com, I remember that, which went bankrupt within 268 days of their IPO, it seemed very logical to short them. However, the bubble's speculative frenzy, it made it nearly impossible for short sellers to hold their positions, because you kept on thinking it's going to burst soon, but it didn't. At least, it didn't for a while. Between 1998 and 2000, venture capitalists, they poured $120 billion into unprofitable tech and internet startups and pushing valuations to 40 times revenue, far beyond the norm of 2 to 3 times revenue. And there were clear signs of overvaluation, but many short sellers had to capitulate under intense market pressure, because the Nasdaq, it surged by 86% during 1999, and it trapped an awful lot of bearish short seller investors, turning their positions into what traders called the pain trade. One hedge fund manager likened shorting dot-com stocks to fighting a hurricane with an umbrella. The momentum was unstoppable. Now, short sellers were ultimately proven correct, but many suffered heavy losses before the market corrected. And one good example of this was Julian Robertson of Tiger Management, a fantastic investor, hedge funder, short seller. He was one of the most renowned casualties of the dot-com bubble because Robertson was, of course, skeptical of the soaring tech valuations, and he took significant short positions against the dot-com stocks. However, the stocks continued to rise, Tiger Management hemorrhaged capital, and by March 2000, Robertson had to announce that he was closing the fund, citing, of course, irrational market behaviour for favouring tech stocks. And although he was vindicated when the bubble burst, it was too late for his firm. Now, just to note, Robertson didn't go broke. He was worth about 4.8 billion when he passed away at the ripe age of 90, I think, in 2022. But what the dot-com era underscored was a real reality when it comes to short selling. Even when short sellers are right, timing is everything. And the dot-com bubble, it serves as a reminder that rationality, it often loses in the face of an irrational market. And the markets can often be irrational. Because, of course, as Jesse Livermore pointed out, it's the human element that's the most illogical and unstable part when it comes to investing and when it comes to the markets. Now, the next story we're going to cover is probably my favourite. And it's one that I actually hadn't heard of. This is the Porsche Volkswagen squeeze. This happened in the midst of the financial crisis in 2008. So short sellers were shorting Volkswagen. Why? Because Volkswagen looked like an ideal short target. The company was burdened with debt, and the 2008 crash had decimated demand for new cars. But somehow, Volkswagen stock remained kind of high. And this only fueled the belief among short sellers that a steep decline was inevitable. But what they didn't realise was that as early as 2005, Porsche had been quietly buying up Volkswagen's shares. And by 2008, the short seller interest in Volkswagen had ballooned to 12.8% of the shares. And by this stage, though, Porsche already had secured 42.6% of Volkswagen's ordinary shares, but it also controlled another 31.5% through cash-settled options. This was a way of sidestepping disclosure rules. So they had this big chunk of shares. On top of this, the German state of Lower Saxony held 20%. So this meant that only 6% of Volkswagen shares were left for trading. But the short sellers didn't know this. And the short sellers' interest was over double that amount at 12.8%, creating a perfect trap for short sellers. And as I said, they didn't know about this until Porsche delivered their coup de grace by announcing their position in a press release on a Sunday. And in doing this, they ensured that the short sellers had to watch helplessly as markets remained closed, fully aware of the carnage that was going to happen on Monday when the markets opened. And it was carnage, because when trading resumed on Monday, the short sellers, they scrambled to buy shares, but there was none left. Volkswagen stock, as a result, skyrocketed. It went from €210 to €1,005 in just 2 days, valuing the company at 370 billion. In other words, at that time, Volkswagen briefly became the most valuable company on earth. And the total losses from the short sellers are estimated to be about 30 billion. These short sellers were big hedge funds such as Elias Associates, Greenlight Capital, Greenhill Capital, Viking Global Equities. They took massive hits. Now, they did sue Porsche for market manipulation, but their claims failed. Porsche's strategy, while ruthless and cunning, it was totally legal. And it also led to one of the most ironic and one of my favourite headlines in financial history. This is it. Porsche, the hedge fund that also makes cars. Porsche had executed it has to be one of the best financial ambushes ever seen. And of course, very few people shed any tears for the hedge funds that were left on the other side of it. So our final story happens on January 24th, 2023. And this is when the US-based firm Hindenburg Research, they dropped this bombshell report. accusing the Adani Group, which is one of India's largest businesses and one of the most prized businesses. It's like this national treasure. They accuse it of pulling off what they called the largest corporate con in history. So, pretty serious allegation. According to Hindenburg, Adani was involved in, stock manipulation, accounting fraud. Now, Hindenburg isn't some random outfit. It was founded in 2017 by Nate Anderson. And I suppose their biggest break came with the Nikola scandal in 2020. This is when they exposed this now infamous video of what was supposed to be an electric truck that was driving on a flat road. This is for a promotional video that Nikola put out. But it was actually a truck with no engine in it, no motor, no nothing, and it was just rolling down a hill. But it was manipulated to look like it was on a flat road. Ultimately, this led to the conviction of Nikola's founder, Trevor Milton, though he never served a sentence because Trump pardoned him. But back to Adani. Hindenburg claimed that they did a deep dive research. They did interviews with former Adani executives, they did site visits, they did financial sleuthing, you name it, because they do dig deep. And their key allegations were massive overvaluation of Adani stock, which they said could drop by at least 85%. The report outlined excessive debt, where Adani allegedly pledged inflated shares to secure huge loans. There was also governance issues. I mean, they basically were calling it a family business, in that key roles were filled by Gautam Adani, the founder, by his relatives. The report also pointed to offshore shell companies supposedly used to forge documents. Now, Adani, of course, fired back a few days later with a 413-page rebuttal. But the damage had been done. Adani lost $100 billion in market value in just a few days. What was most striking about this story, though, and that's why it came to my attention, was there was a huge nationalistic spin put out there by the Indian government. And Adani themselves, they tried to paint the whole thing as an attack on India itself, calling it a calculated attack on India. Some outlets in the Indian media press even claimed that there was a kind of Anglo-American plot to punish India for not picking a side in the Russia-Ukraine war. But look, it was all just smoke and mirrors. There wasn't any proof of that. That kind of claim that it was politically motivated, that was just nonsense. Hindenburg, in fairness, doesn't operate like that. Anyway, things seemed to cool down for a while, and Adani shares recovered somewhat. But Hindenburg seems to have been onto something, because in November 2024, Gautam Adani and 7 other people employed by the company were indicted in a New York federal court on charges of agreeing to pay hundreds of millions in bribes to Indian government officials between 2020 and 2024. Now, of course, Adani has denied those claims, but it must be said, there are historical accusations of crony capitalism. They followed Adani around for years, especially because of his very cosy ties with the Prime Minister Modi. So this is a story that's going to be well worth watching over the coming months. Funnily enough, though, I found that despite causing a 100 billion market crash, Hindenburg itself only made around 4 million from the short bet. I thought it would have made a lot more. Now, also, further update on that story, in January 2025, Nate Anderson announced the closure of Hindenburg Research. He said the work had been intense and at times all-encompassing, and I'm sure it was. And there are other reasons, I guess, why he's getting out of it, because activist short selling, it's not an easy game. It's a really tough business, and that's why Wall Street, big Wall Street firms avoid it. The legal risks are enormous. Just last year, the SEC charged Andrew Left, a very well-known short seller, with market manipulation. He's pleaded not guilty and the trial is set for September. Other activist short sellers are frequently sued by the companies that they expose. Like, it's a huge, risky operation. And the short selling business overall, it is kind of losing steam. It's been hampered, obviously, by a decade-long bull market. Also, there's the rise of these passive investment funds, and that has made contrarian bets more difficult. And with the markets, continually trending upwards, short sellers have found fewer profit opportunities. That could change. I mean, markets go down as well as go up, so there's bound to be some correction. But they're also encountering more resistance from retail and institutional investors. And renowned short seller Jim Chanos, the guy behind the Enron short bet, he announced the closure of his short-focused funds in November 2023 after more than 3 decades in the industry. Bill Ackman, famous for his Herbalife short bet, he's sworn off the practice entirely. Now, while some argue that short selling remains a vital check against, speculation and deception, the pool is shrinking. The pool of dedicated short sellers is shrinking, and this does raise questions about the future of this high stakes financial strategy, and also on the check and balances it places on the markets. Despite what many people think of them as vultures, they are, as I said earlier, a necessary evil. And evil is probably too strong a word. Anyway, I hope it continues because there are just so many great business stories involving short sellers. I hope you've enjoyed it as much as I have. And remember, if you have any comments, any corrections, or any story that you'd like us to cover, email us at info@gbspod.com. All the best, folks.